Students, welcome to lecture 4 of week 8, wherein we have been talking about the payment systems in international trade. Today, we are going to understand an important topic, that is instruments of payment, which includes checks, drafts, and bank guarantees. Let us begin the journey. First of all, we will go through the contents of today's lecture. We will start with introduction and role of payment instruments, followed by classification of instruments in international trade. After that, we will be discussing the checks, its concept, parties involved, and types, followed by bills of exchange or drafts, its meaning and mechanism. Subsequently, we will talk about demand drafts and their application in trade. After that, we will focus on bank guarantees, its concept and importance, followed by types of bank guarantees used in export trade. After that, we will be discussing comparison between drafts and bank guarantees, followed by legal and regulatory framework. Subsequently, we will delve into the issue of risks, safeguards, and technological advancements. The penultimate discussion will be about cases and practical insights of the concept, after which we will finally conclude our lecture. At the outset, we all are aware that payment instruments formalize the transfer or assurance of funds in international trade. It means that the payment instruments facilitate the transfer of money from one party, that is buyer, to another party, that is seller, in international trade. Payments are important because they are the end result of export and import. Once the goods has been shipped and they have been delivered to the buyer has to pay the fees, or the buyer has to pay the cost of those goods in line with the export contracts. Thus, payment instruments becomes very important to understand and to know that which instruments are useful for a specific organization. The payment instruments support trust, compliance, and documentation between exporters, importers, and banks. We all know that the trust in the payment systems is very important. What kind of payment instruments are being used defines about the trust between the parties. A bills of exchange has different kind of trust, a draft has different kind of trust, check has different type of trust. So all these instruments bring about some trust between the parties. Also, in certain cases, they may be complying with the rules and regulation. Some payment methods are more used in certain trade formats in comparison to others. So all this depends on how we are perceiving, but the important point is that these payment instruments are very important. In addition to this, major traditional instruments which are being used in international trade are checks, drafts, and bank guarantees. Now, these three are the most widely used instrument, though they are not the modern instruments, but still, as of now, they are most widely used because they are traditional. Everybody is aware about them, and in their personal lives also, everyone who is connected to import export business is using these kind of documents, that is instruments, financial instruments. So, because everybody connected to the networking of international trade is already using these kind of payment instruments, thus it becomes easy for the businesses, for the exporters to use the same instruments in international trade. Thus, they are traditional and widely used. Also, each one of them serves a unique purpose in ensuring payment or performance under cross-border transaction. Every payment instrument has some uniqueness with respect to its features, its usage, its benefits, and its limitation. Any exporter who wants to use a payment instrument should look towards all four dimensions. That is, what are the benefits, what are the limitations, what are the common uses of it, etc., to understand that which payment instrument will be the best for this business organization. Let us now try to discuss about the purpose of payment instruments in export import trade, that is EXIM trade. The first is it provides legal and financial assurance of payment. Because all these payment instruments are the formal ways which are going through proper banking and financial system, thus their authenticity is determined, and thus the assurance of payment is finalized because of using these payment instruments. These payment instruments also reduce transaction risk across borders because there is some level of trust and legitimacy in using these payment methods. Also, some level of guarantee or assurance of the payment is instilled into the payment instrument which we are using. So, because of these particular things, these using these payment instruments reduces the risk across borders. Similarly, it also serves as a negotiable evidence for settlement of trade obligation. Negotiable Negotiable evidence means that if there is any kind of conflict or if any negotiation is going on some further issues, then the payment instrument is the evidence of either the payment which have been made or either obligation of the payment which has been promised. Now these things make dispute resolution very easy because one aspect is clear and there is some evidence for it. So this also serves for that purpose. In addition to it, payment instruments enable exporters to secure finance and liquidity based on all the different types of instruments which they are using. Now, securing finance is very important for working capital management, as well as liquidity is also important for meeting out the day to day operations and expenses. Thus, overall, these instruments provide lots of assistance to the exporters. And finally, use of these payment instruments establish credibility between buyers and sellers, or it is also a kind of trust between buyers and sellers, particularly when new exporters are going or new trade relationships are being exports. So because of all these benefits, all the purpose of payment instrument is to provide all these supporting elements for facilitating the export import trade. Let us now move on to discuss classification of payment instruments. There are different types of payment instruments that are being used in international trade. The first classification states it is negotiable instruments. These are these include checks, bill of exchange and drafts. The second type of payment instruments are the banking commitments like bank guarantee, which is in short known as BG, standby credits, etc. The third classification type is documentary instrument such as documentary collections and letter of credits. The fourth type is electronic instruments such as SWIFT, e-bank guarantee, digital payment systems, etc. And the fifth type of payment instrument is hybrid instruments, which includes the performance bonds and demand guarantees. Now, if we have a look towards all these classification, we can see that each classification has a different base or principle, but each serves a different and unique purpose. And all of these are required. Sometimes the combination of these are used to facilitate the trade. So we cannot say that one is more important than another. It depends on the nature of the business, size of the business, from where the business is originating, the awareness and knowledge of the exporters, etc. So we can only say that all these classifications are in practice, and all these classifications are very important for facilitating international trade. Let us now try to come up specifically on some instruments that are being widely used in international trade as payment instrument. The first is check. We'll try to understand its concept and note. Check is defined under Section 6 of Negotiable Instrument Act 1881 in India. Thus, it is a kind of negotiable instruments. It is a kind of written order by an account holder to their bank to pay a specific sum to a party. It is very commonly used in domestic or low value trade transactions. That is why everybody is aware about check as a payment instrument. Even people who are not exporters but they are common man, they also use check as payment instrument. Then it has limited use in international trade due to verification delays and dishonor risk, because there may be bouncing of the check, which is known as technically dishonoring of the check. Because of this reason, the checks are not very much used in international trade, so they are used for limited purposes. And check acts as a simple but non-secured payment method. It is a simple method but it is not secured method, and thus checks are used in international trade but not too much. Let us see a sample of a check. You can see that this is a check, a sample check, which has been, published by the Punjab National Bank. It means the account holder belongs to Punjab National Bank. You can see the details of RTGS and NEFT, IFS code. These are mentioned. These are just hypothetical, but in real times there will be some kind of RTGS or NEFT IFS code of the bank is there. Then the address of the bank is mentioned on the check. You can see the date of the check is also given when the check was drawn. It means on 6th March 2024 this check was prepared. Okay, and it is to pay to the company. We have written demo check private limited because this is just a sample. So here you can write the name of the exporter. If importer is paying, they will write the name of the exporter. So some private limited will be there. How much you are paying, so that amount is written in words and it is in figures: 58 lakh 67,937. You can see these two things should match properly. Account number of the holder whose account is in Punjab National Bank. So whatever is the account number, it will come here. It is automatically printed. Generally the account number is printed on the check, but because this is sample, so we have not shown. And type of account is mentioned. It is a current account, or it can be in business. Obviously it is always a current account. If for personal people it is savings account, so it will always be a current account. Then signature, authorized signature, who has the authority to make payment on behalf of this account number or the account holder. If it is a joint account, it's a company account, then the company's chief financial officer signs will come here because he has the authority to pay using the company's accounts. So all this is the information which is used in check. So we can see in check some minimal information is being used, and it is widely used in common parlance, but international trade it is used but it has only a limited use of it. Let us now try to understand the different parties that are involved in a check. The first party is drawer, which is buyer or account holder issuing the check, whose bank account is mentioned. The second is the drawee, the bank responsible for honoring the check. The third party is payee, exporter or beneficiary entitled to receive the payment, and the fourth party is endorser or endorsee, that is parties transferring or receiving the check through endorsement. The next type is, let us now try to discuss types of checks used in trade. The first is bearer check. This check is payable to holder on presentation. The second type is the order check, wherein it is payable to a named payee or order. The third type of check is cross check, which is payable only via a bank account, ensuring traceability. The fourth is the banker's check or pay order, which is issued by a bank on itself and it has high reliability. The fifth type of check is foreign currency check, which is drawn in foreign currency and it is subject to clearance delays. Let us now try to identify the advantages and limitations of checks. There are two main advantages of check. The first is the checks are the simple payment instrument, as well as they have low cost for bearing the payment. The second advantage is the checks provide written and dated proof of transfer instruction. Thus, the dated proof is very important for avoiding conflicts or resolving disputes in payments. However, there are certain limitations of checks as well. The first limitation is that there is no guaranteed payment because a check can be dishonored when the check is submitted by the party, and if the account does not have the sufficient balance, then the check may dishonor. Check may also dishonor because of some mismatch in the details as well. So that's there is no guaranteed payment by the bank. The second limitation is exchange rate risk during foreign clearance. There may be exchange rate fluctuations, and because of exchange rate fluctuations, there may be problem in foreign clearance. The third limitation is there can be collection delays, especially across different jurisdictions. Thus, an exporter has to look towards the advantages as well as the disadvantages while deciding whether checks should be used as the payment instrument or not. Dear students, let us now move on to discuss another important payment instrument, that is draft or bill of exchange. This is defined under Section 5 of the Negotiable Instruments Act 1881. This is an unconditional order which is written, and it is written this is this is an unconditional written order by a drawer to a drawee to pay a prescribed sum. It is commonly used in documentary corrections and deferred payments. Bill of exchange provides legal recourse for dishonor or default, as well as it is used in both clean and documentary trade settlements. Let us discuss a sample of bill of exchange. So you can see this is a sample format of a bill of exchange, in short written as BE. The total bill of exchange value here is mentioned, that is 2 lakh rupees, 2 lakh. So the currency should also be written rupees 2 lakh. And place, say for example it is being issued in New Delhi. Date, for example 23 March 2025. Stamp will be there, and 60 days after the date, pay Mr. ABC a sum of rupees 2 lakh for value received. So value received means they have received goods, and now the payment of 2 lakh will be paid after 60 days. Now let us assume this instead of March to be August, so that we can decide. So August, September, October, it means 23 0 23/10/2025. That will be date which will be making it 60 days. It means after 60 days the payment can be made of 2 lakh rupees to Mr. ABC. Okay, so this is mentioned over here. Accepted by the parties, the drawee's name, address, signed and accepted. Here we have drawer, signed and drawer. So both the parties are here agreeing to this particular statement that a sum of rupees 2 lakh for which value has been received will be paid after 60 days. Now in between also, if the exporter wants to have some money, then the banks can give some money to the exporter by deducting some commission. So within the 60 days, if the exporter wants to have money, he may get, say for example, 1,80,000 or 90,000, and 10,000 can be deducted by the bank for the commission. And after completion of 60 days, the bank will be taking the money, total money of 2 lakh from the importer. So you can see this is a very comprehensive document, and this is with the mutual agreement of both the parties, and it is very widely used in international trade for payments. Now see what are the different parties that are attached to a bill of exchange. The first party is drawer, that is exporter demanding payment. The second party is drawee, that is importer instructed to pay. The third party is the payee, recipient entitled to funds, that is exporter or nominee of the exporter. The fourth is endorser or endorsee, that is the subsequent holders of the bill of exchange. And the fifth one is accepting bank, that is the bank which may guarantee payment in DA, that is acceptance conditions of the arrangements. So we can see all these parties are mutually coming together to facilitate trade with the help of this payment instrument, bill of exchange, and it is widely used in international trade. Let us now try to see what are the different types of bill of exchange that are in practice. The first is sight bill, which is payable immediately on the presentation. The second is usance bill, which is payable after a fixed period, for example 60 days. The third is clean bill. When we say bill, it is clean bill of exchange. It is without accompanying any documents. The fourth is documentary bill of exchange, which is very important. It has commercial and shipping documents attached with it. The fifth is freight bill of exchange, which is between buyer and seller. The sixth is bank bill of exchange, which is issued or guaranteed by the bank. Thus, all these different types of bill of exchange are available for the exporter and importer to explore and use. But remember, students, that exporter and importer should use those types of bill of exchange that easily facilitate the trade between them. Their specific situation, their condition, their contract arrangements are very important to determine that which bill of exchange will be relevant and suitable for their arrangements. Let us now try to focus on the role and benefits of draft in export-import trade. Drafts are legally enforceable and are negotiable instruments. Drafts enables credit sales and deferred payments. As well as drafts can be discounted for post-shipment finance. Drafts are generally used under URC 500, which is related to collections, as well as UCPDC 600, which is related to credits. Drafts also establishment documented evidence of the buyer's payment commitment. Let us now move to demand draft, which is also known as banker's draft. Bankers' draft are issued by one bank or another branch or the correspondent bank abroad. The demand draft or the banker's draft offers higher security than personal checks because they are prepaid. Thus, there is no issue of dishonoring. Thus, we can say there is no dishonoring risk associated with demand draft. These are very common in terms of remittance or small value settlements in case of international trade. Demand drafts are handled under Foreign Exchange Management Act of 1999 and RBI's authorized dealer framework. Dear students, let us now move on to another type of payment instrument, that is bank guarantee. Bank guarantee is a written undertaking by a bank to pay a specified sum if the applicant, that is buyer or exporter, fails to fulfill contractual obligations. This is commonly used in international trade for performance assurance or for financial security. This provides much more security because the guarantee of the bank is involved in payment mechanism. Thus, it is beneficial for both exporter as well as importer. Bank guarantee provides protection to beneficiaries against default, non-performance or breach. Bank guarantees are governed by URDG 758, that is Uniform Rules for Demand Guarantees, issued by International Chamber of Commerce. Here we have a sample of bank guarantee, and we will be discussing what are the different components and contents of the bank guarantee. You can see this is a letter of guarantee by a bank. First capital auction, this is the address, bidder's name is there, and this dear sir. And if you we go through the content, let's talk about all the details related to bank name, the customer name, amount which is being guaranteed, the customer's account number. All these details form part of a bank guarantee. And the guarantee's purpose is also mentioned. Here you can see it is written, this guarantee is for the purpose of our customer purchasing vehicles or other property in connection to auction this. So the exact nature of the activity is also mentioned, and a specific timeline of the guarantee, and other different provisions are explicitly mentioned in the letter of guarantee. So you can see at least 15 days time is specified in it, and bank officer's signature and customer's signature, because these two become the parties of this document. So we can see that this is a sample document of the letter of guarantee, and it includes such information which are required like amount, the nature of the activity, what is the amount, and all other things which are relevant. And both the parties involved, they do complete and they start promoting this letter because there is a specific guarantee of the payment. Let us now try to identify the different parties that are involved in a bank guarantee. The first is the applicant or the principal, which is the party requesting issuance, such as importer or exporter. The second party is issuing bank, which provides the guarantee on behalf of the applicant. The third party is the beneficiary. It is the party in whose favor the guarantee is issued. The fourth is advising or confirming bank, which may authenticate or confirm the guarantee internationally. So all these parties together hold the bank guarantee as a payment instrument. Let us now try to throw some light on the different types of bank guarantees. The first is financial guarantees, that is, which ensures payment of monetary obligations. The second is performance guarantee. It covers performance of contract or delivery obligations. The third type of bank guarantee is advance payment guarantee. This protects buyers' prepayment in case of exporter default. The fourth type of bank guarantee is bid bond or tender guarantee that ensures bidder maintains commitment if contract is awarded. And the fifth type of bank guarantee is deferred payment guarantee, which covers long-term credit-based sales. Dear students, let us now try to discuss the mechanism of a bank guarantee. A bank guarantee mechanism is due process which needs to be followed to successfully complete the bank guarantee scheme. In it, applicant requests bank to issue a guarantee, after which the bank assesses applicant's credit worthiness and issues guarantee to beneficiary. The third is bank beneficiary claims payment if applicant defaults or fails to perform. The fourth is that bank guarantee mechanism is where bank honors claim per guarantee terms, recovers amount from the applicant. And finally, the bank guarantee acts as a risk transfer mechanism ensuring trade reliability. Dear students, let us now try to compare between drafts and bank guarantees. On the first column, we have the parameter based on which we are going to compare. Second column is for bill of exchange or draft because they have both same features. And then we have the bank guarantee. So with respect to first parameter, that is nature, bill of exchange is a payment instrument. On the other hand, bank guarantee is considered to be a security instrument. With respect to function or functional parameter, bill of exchange and draft both facilitates the trade payment. On the other hand, bank guarantee ensures performance or payment. With respect to the third parameter, that is legal framework, bills of exchange or draft comes under Negotiable Instrument Act 1881 of India. On the other hand, bank guarantee falls under URDG 758 or banking contracts. With respect to risk level, in bills of exchange and draft, the risk is moderate, while on the other hand, in bank guarantee, risk is very low for the beneficiary. With respect to bank's role as a parameter, in terms of bills of exchange and draft, bank collects or accepts the payment, while on the other hand, for bank guarantee, it provides guarantee obligations. With respect to last parameter, that is use stage, bills of exchange or drafts are used at the payment stage, while on the other hand, bank guarantee is used in the pre-contract or execution stage of export and import. Thus, an exporter can compare that which type of document the policy, the payment instrument is responsible or applicable to the exporter. Depending on the need of the exporter may select either bill of exchange or draft or bank guarantee and then proceed with the international trade. Let us now try to identify the importance of bank guarantee in export trade. The first important point related to bank guarantee is that it enhances buyers' confidence in contract performance. The second benefit is it facilitates participation in global tenders and projects of the exports. The third is that bank guarantees enable exporters to obtain advance payments securely. The fourth importance of bank guarantee is that they act as credit support for exporters in new markets. From time to time, exporters explore and want to enter new markets, and bank guarantees are such kind of payment instruments that supports new exporters to enter new markets. And finally, the bank guarantees also reduces financial exposure for importers and project owners. All these features are very important, which makes bank guarantee a very interesting concept for export trade. Let us now try to identify the legal and regulatory framework for bank guarantees. Bank guarantees are governed internationally by URDG, that is Uniform Rules for Demand Guarantees 758, which is formed under the International Chamber of Commerce. Also in India, these legal and regulatory frameworks for bank guarantee are controlled by Foreign Exchange Management Act 1999 and RBI Reserve Bank of India's Master Circulars on Guarantees, which are published from time to time. These bank guarantees are issued only through authorized dealer bank AD banks, which are known as AD banks in short, because they are given the authority to look into the guarantees and then only they can proceed. In addition to this, these bank guarantees are subject to due diligence, credit limit, and margin requirements. And bank guarantees finally, claims under bank guarantees must comply strictly with terms of the guarantees that are determined from based on each country's specific situation. Dear students, let us now focus on the risk and safeguards associated with bank guarantees. The risk includes fraudulent invocation or unjustified claims, ambiguous or open ended wording, political or country risk in cross border guarantees. On the other hand, if we talk about safeguard measures that are present in bank guarantees that can be used in a positive manner for international trade, they include dra- drafting guarantees with clear trigger conditions. The second is they use the second is using counter guarantees or standby letter of credits for support. The third is maintaining strict compliance and claim verification timelines. Dear students, let us now move on the technological advancement, that is e-bank guarantees. The e-bank guarantee systems are launched by major banks and trade platforms, for example, SWIFT, NESL, that is National E-Governance Services Limited, etc. These are digitally issued and they help in authentication of the export mechanism, payment mechanisms, as well as the claim management. They reduces forgery, paper dependency, and processing delays. As we know that using paper makes the task more complicated, more space is required for storing of the documents, and even that can lead to processing delays. Thus, switching over to digital framework platform and cloud services makes it much more easier for accessibility and storing of the documents as well as payment instruments. The e-bank guarantee schemes also enables integration with trade finance systems and blockchain verification. It means the e-bank guarantee mechanism is now inculcating the new technology and technological innovation as well, which is the future of the financial world. Finally, e-bank guarantees also enhances transparency and global enforceability. Dear students, let us now try to focus on a case illustration. We have taken a scenario. An Indian engineering exporter receives a performance guarantee from its bank in favor of Middle East buyer for 1 million United States dollar. So we have an Indian exporter and a Middle East importer. So both are coming together, but the guarantee is related to performance. And the total valuation or amount is 1 million United States dollar. The exporter fails to deliver equipment within contract period. Suppose the period was 5 months. Within 5 months, the exporter has failed to provide that engineering good, excuse to the importer, that is in UAE. Now this is creating a Now, this is creating a problem. What is the outcome? The buyer invokes the guarantee because buyer is not satisfied. He is receiving the goods after the time that was agreed upon. Bank pays the amount. The exporter's reputation and security limit is now affected. The lesson paper the lesson proper contract management and compliance are vital, that is important to avoid guarantee invocation. Dear students, let us now conclude whatever we have discussed in today's lecture. We have identified and discussed checks and draft facilitate direct or documentary payments. In addition to this, we have also learned that bank guarantees provide assurance of payment or performance, enhancing trust. Then, together, they form the backbone of international financial instruments in trade. Also, we have learned that these type of payment instruments are governed by national or international frameworks, ensuring fairness and reliability. Not only this, understanding their function, legal basis, and risk implications is vital for successful export growth. Dear students, with this we complete our discussion. Thank you very much for being with me in this session.